You've probably heard this your entire life. Renting is just throwing money away. Buying a house is the best investment you'll ever make. The path to wealth is paved with a white picket fence. But in 2026, that advice isn't just outdated, it's dangerous. Blindly following the old rulebook could end up being the most expensive mistake of your financial life. The game has changed. The global housing market has gone through a seismic shift, and the math has been completely rearranged. So today we're breaking down the new rules to give you a clear, data-driven answer to one big question: is renting or buying the real path to building wealth in today's economy? Let's start by tearing down the biggest myth in personal finance. Renting is throwing money away. It sounds catchy, but it's deeply misleading. When you buy a home, a huge chunk of your monthly payment is also money you'll never see again. Think about it. Mortgage interest, property taxes, homeowner's insurance, maintenance and repairs. None of that builds equity. It's simply the cost of having a roof over your head, and once it's paid, it's gone. In the first several years of a typical mortgage, the vast majority of your payment goes toward interest, not principal. You're essentially renting money from the bank. The idea that your primary residence is a pure investment also needs a reality check. You buy a home to live in it, which makes it a hybrid, part utility, part emotional decision, and part financial asset. Treating it like a guaranteed moneymaker is risky in 2026. The frenzy of the last few years is over. Forecasters now expect slower, more modest home price growth, often in the 2 to 4% range in many areas. This isn't a crash, but it is a fundamental shift, and it changes the entire financial calculation. So if the old rules no longer apply, what are the new ones? To get a real answer, we need a new framework. Forget the clichés. Let's run the numbers. We're putting renting and buying head-to-head in a 3-round financial battle. By the end, you'll have a clear, data-driven answer. All right, let's get specific. For this comparison, we'll use a common scenario, a $450,000 home. Round 1, the upfront cash battle. This round is a knockout. To buy a $450,000 home, you'll likely need a down payment. If you put down 20% to avoid extra insurance, that's $90,000 in cash. Then come closing costs, which typically run about 3 to 5% of the home's price. We'll estimate $18,000. That means your total upfront cost to buy is $108,000. Now let's look at the renter. To move into a comparable home, you might need a security deposit. If rent is $2,500 a month, your upfront cost is maybe $5,000. That's a difference of over $100,000. But the real story here is opportunity cost. That $108,000 the buyer puts into the house is now tied up and illiquid. The renter, on the other hand, still has that capital available to invest. What happens to that money is the single most important and most overlooked part of this debate. Round 2, the monthly cash flow drain. This is where things get interesting. Let's assume the buyer takes out a mortgage for the remaining $360,000. Mortgage rate forecasts for 2026 vary, but many projections fall between the high 5s and mid 6% range. We'll use 6.3% for this example. That makes the monthly principal and interest payment about $2,225, but that's not the full cost. Add property taxes, around $400 a month, homeowner's insurance, about $150 a month, and maintenance. A conservative estimate is 1% of the home's value per year, or roughly $375 a month. All in, the true monthly cost of owning comes to about $3,150. The renter, meanwhile, pays a flat $2,500 a month. That means the renter has an extra $650 in their pocket every single month. In many major U.S. markets, this is already the case. Several 2025 analyses show that owning often costs significantly more than renting, and depending on rates and prices, that gap could easily persist into 2026. Round 3, the 10-year wealth race. This is the final round. Let's fast forward 10 years and see who comes out ahead. First, the homeowner. They've been paying down their mortgage and building forced equity. Let's assume their home appreciates at a modest, sustainable rate of 2% per year. After 10 years, the $450,000 home is worth about $548,000. Their remaining mortgage balance is around $295,000, leaving them with roughly $253,000 in home equity. Subtract the original $108,000 they put in, and their net wealth growth is about $145,000. That's a strong outcome. Now let's look at the disciplined renter investor. And this word matters, disciplined. They invest the initial $108,000 instead of tying it up in a house. They also invest the $650 they save every month. Assuming a historical average market return of 8%, here's what happens. After 10 years, the lump sum grows to over $233,000. The monthly investments add another $119,000. In total, the renter investor's portfolio is worth more than $352,000. To be clear, both paths build wealth, but in this scenario, the disciplined renter ends up with more than double the net gain of the homeowner. That's the power of opportunity cost. Of course, this decision isn't just about spreadsheets. There's a very real human element. Renting offers flexibility. You can move for a job, travel, or change neighborhoods without the cost and stress of selling a home. And when something breaks, you make a phone call, not a $2,000 payment. Buying, on the other hand, offers stability and control. You can paint the walls, renovate the kitchen, and put down roots without worrying about a landlord selling the property. And as we've seen, home ownership acts as a powerful forced savings mechanism, which is a major advantage for anyone who struggles to invest consistently. There's no universal right answer. The real question is simple. Which lifestyle actually fits the life you want to live? So what's the verdict? In 2026, the winner depends entirely on your timeline and your discipline. For the short term, anything under 5 years, renting is often the smarter financial move. High transaction costs mean buying takes time to break even, and with slower appreciation, that break-even point could be anywhere from 3 to 7 years or even longer in some markets. For the long term, if you're confident you'll stay put for at least 7 to 10 years, buying can still be a powerful wealth-building tool, especially if appreciation remains steady. Over time, you build equity, and your housing costs are largely fixed while rents continue to rise. In fact, data from the Federal Reserve's Survey of Consumer Finances consistently shows that homeowners tend to accumulate significantly higher net worths than renters. Renting and investing, the difference often wins on paper. But buying a home has historically worked for more people because it forces discipline. Don't just take my word for it. The most important numbers are your own. This calculation changes dramatically based on your city, your rent, and local home prices. So do this. Search for a rent versus buy calculator. Plug in real numbers from your area. Then come back and tell me in the comments. For you and your city in 2026, what's the verdict? Renting or buying? The old one-size-fits-all advice no longer works. In 2026, choosing between renting and buying isn't about following a cliché. It's about understanding the new rules and running the math for your life. It's about deciding whether you value flexibility and market returns or stability and forced savings. The right choice isn't the one your parents made. It's the one you make with open eyes, clear numbers, and the right data.